All right, then. I like to start punctual, so let's kick it off. Thanks for coming on to this webinar today. I thought it was quite an interesting webinar to have during the racing week because a lot of people are investing in a certain enjoyment or gambling, and hopefully I can give you some insights on what you should be investing for yourself. So I'm just going to, today's structure, we're going to run through it really quickly, 15 minutes, punch through it with a few slides, and then I'll revert back to myself. And during the presentation, can you just write any questions that you may have just in the group chat functionality, and that way I'll address in the last 15 minutes any questions and we can have a bit of a Q&A session. So let's get into it. Okay, so today's topic was an interesting one, which was brought out of a few discussions after the last webinar that we had, where people were like, it's all well and good, I'm learning about these different investments, but what's the right investment for me? And what is the secret to successful investing? Because we've all got exposed to the same research out there. Information now has become a bit of a commodity. It's all on the internet. It used to be that investing was about having the right information, but now we pretty much do have the same. But how come some people are really great investors and others actually aren't? And that's what we're going to discuss today. Okay, so just trying to work out how to go to the next slide here, sorry. No, I just can't work out how to go to the next slide. Sorry, here's Sarah, just the technical difficulties. All right. So we're just going to quickly go the secret. We're going to then talk about goals and values, simplicity over complexity, and then the other secret, and then next steps. So the first secret, really it's just about taking action. It's about doing something. Investing confuses a lot of people and it stresses them out and it scares them. But the biggest thing is just to start. There's really no one perfect investment. If there was, we'd all be investing in that one particular investment. Just make sure you start small, and then as you actually go on the investment journey, you learn. Warren Buffett at the start wasn't a genius investor. What he did was he started researching more and more, and like anything, as you spend more time doing it, you'll learn more about it and you'll learn what's right for you. The first thing you've got to do, and this is something which we do a lot at Wealth Enhancers, is to really work out what are your goals and values. Now, there's a lot of people out there talking about this is the right investment. You should be investing in this particular property or this company or in this business. And yes, it may be a good investment, but is it actually a good investment for you? So the approach that we like to do is we look at what are your actual goals? What's the goal that you're trying to achieve? Are you trying to build up a certain amount of assets to be able to one day buy a house with? For you to live in, or are you trying to look at an income stream to supplement your income? Are you trying to save for kids? And you work out that actual goal. You then determine when is it going to be done by. Do you need it in 1 year? Do you need it in 20 years? So some more short-term goals generally are holidays. Longer-term goals are things like buying a house to live in with my family one day or retiring. We then need to work out how much is that actual amount. What is the actual amount for that goal? Because everyone's version of one particular thing, like buying a house, can be completely different. One person might imagine a two-bedroom apartment in outer suburbs of Melbourne. Another person might be thinking a mansion in Bondi Beach. So we really need to determine what is that dollar amount. And this dollar amount can actually shock you sometimes when you actually look at it. One that we actually look at is kids with private school investing. and it works out to be about $800,000 for 2 kids over the lifetime to put kids through to private schools. Then do you actually get into, well, what is the actual investment type which is suitable for the goal? Is it, if it's a holiday and it's short term for a year, you're probably not going to buy a property to invest in it because you're not going to be able to sell it quick enough. So cash would be more suitable. If it's for a longer term goal, like for your children's education, then a property or shares would be a lot more suitable. And then I think the most important part, which we come back to, is which is a cross-check, is it aligned with your core values, the values which are the drivers for who you are? And everyone has different values. I can give you an example personally. So I value flexibility, freedom, I value experiences, travel. So certain investments do not suit me. Right now, I don't have an investment in my own home because I see that as a burden. I see it as something which is going to tie me down. So I have more liquid investments. Other people really appreciate their own home. And we've got some great members who have done some very shrewd investments with their homes, and they actually really appreciate it. So know what's suitable for you. And that also comes back to your risk profile as well, is can you actually handle the responsibility which goes with that investment? So think about that type of thing. Once we go through all that chart, we actually look at, well, all right, what are the best investments for you? How much do we need to allocate to them? And what are the right investments at this particular time? The next part is simplicity over complexity. And this is a big one with our generation. We work with Gen Y, and we're renowned for changing our minds. Look how many careers most of us had by the age 30. I've had 3. We like to just be able to suddenly go, I'm going to go take a year off. I'm going to go travel. I want to go do an MBA. We're not like our parents' generation. So it's very important to know that we actually like things quite simple. If your investments are really complicated, you will end up getting frustrated by it because it's going to be taking up your time, which you could be spending working or socializing or traveling. It's also going to get you frustrated because it's annoying. There's a lot of work involved. So really think about that side of things. I had some clients in our private client business who are older. They love the complexity of having multiple shares in their portfolio and different investments because they had really nothing else to do. Each weekend, they would sit down and they would spend the whole day looking through the newspaper, looking at their different performances and having to track each one of them and having the discussions with me. Me personally, I prefer just knowing that it's out there being managed, and I'm linked to the markets. And it's really simple. So I'll always opt over someone managing it over myself. So really work out how you like it and keep it simple. That's old KISS principle. Keep it simple, stupid, is something which is quite important with our generation. We're finding that a lot of people at the start, they don't have that much money, so they're fine. They'll just follow in any investments. And they think once they build up a lot more assets, they need to start complicating things. And it's not actually true. The principles of investing, whether you've got $10,000 or 10 million, are ultimately the same. And this is why in Wealth Enhancers, we don't charge an asset-based fee, because it's really the same amount of work to manage a $5,000 portfolio as it is $1 million portfolio. You just have a greater percentage of the actual investment with a larger amount. What comes with added assets is options. When you've got larger amount of money, you have more options to be able to get into certain investments. Like you could invest in property once you've got a larger amount to get a deposit, or you could invest in some startup companies. But that comes with a price as well, because it's complex. I actually was just sitting here for 20 minutes before going through my self-managed super fund and having to find a lot of documents for the startup investments that we have. And I was sitting going, this is actually really complicated, and is it worth my time? So where my direct shares were just sitting there automatically feeding in. So don't feel like you need to overcomplicate things just because you've got more money. The principles are the same. Warren Buffett gave that a really good example when he announced what he's doing with his will. He's leaving to his wife pretty much 90% of the investments in the S&P 500, which is directly linked to the share market in an ETF, because he believes that not many people can outperform the share market, and it's simple. And his wife has never been involved in investments, so why complicate it with having all the investments that he has in all the different businesses? Just make it simple. So know whether you have an interest in it and how complicated you actually want to make it. The other really big simple secret is compound interest. I love compound interest. It's unfortunate that most human beings can't actually comprehend it. You basically exponential growth through reinvesting any investment income and going on to earn interest on that income. So it starts compounding. Basically, you're making money on free money that you got the year before. And what's really powerful is it goes in the exponential curve, which if you look at the next chart, it's really flat at the bottom, but then it starts taking off after a certain amount of years. And I love this chart. I don't like to talk about retirement or anything with our generation, because I think we're actually going to have multiple retirements. But if you just look at a simple graph and you wanted to retire at the age 65, the difference between investing at age 25 and 35 is remarkable. If you started investing at age 25, you'd have a balance of $400,000 at 65, and the same person investing the same amount only had $200,000 if they started 10 years later. So you can see that it's actually 100% difference by just 10 years of regular monthly investing. And this is why we encourage all our members, no matter how small or how large, to dollar cost average. Invest every month into share portfolio or into property, and it starts building before you know it. And we've seen some great examples. We've seen some members who started with $100 per month going into a share portfolio, and then over time, as their salary was increasing, we got down their expenses, their share portfolios actually started getting quite large, and people suddenly had $100,000 share portfolios where they couldn't even imagine it, and it just crept up over the 4 or 5 years. And something about compound interest, a little secret, is you start seeing the true benefits past the 5-year mark, and really it's a 7-year mark. But once you start getting over there, you start seeing it jump each month, and you start noticing it. Unfortunately, during this first period, we can't notice it very well because it's only incremental amounts. But if you let it go for long enough, it's a pretty magical experience. This is another chart to show the difference, how much you need to invest at each age bracket to get $1 million at age 65. So if you start at age 20, you only have to do $360 per month. And if you start at age 60, you're having to do $14,000 per month. So looking at this, it's a no-brainer. Why wouldn't you start earlier? And it makes it a lot more easier. And you've just got to look at short-term sacrifices for some really great long-term gains. And it's not even that long-term. People who make some short-term sacrifices in 10 years, they're really benefiting. And the ones who aren't, they're in a long-term of pain. And I think the big final one is don't go broke safely. We're seeing, unfortunately, in our generation, a lot of risk averse with investments. And I think it's because we're pretty young. We were coming out of university into our first year jobs. We might have had a first investment when the GFC occurred. And we saw the fear and the destruction of wealth which can actually occur. But what's actually occurred is we're now sitting in cash, and ultimately when you sit in cash, you generally spend it. So rather than taking risk, and we're seeing people not be willing to build investments. And this graph highlights the danger of being in cash. $100 invested 190 years ago, just for real returns, is now worth $207, where if you invested in Australian shares, it would have been $210,000. And on this chart, each of those little dips were one of these big crashes. So it's important to understand risk, but also understand that in our lifetime, we're going to see a lot of market volatility. And the most important thing is just to make sure that you have money going into investments every month, and you're also not living above your means. I want to talk briefly about where to go from here, and then we'll get into a series of questions that I can answer to be able to actually continue the chat. But we're offering a free financial kickstart session. And in this session, we have built this to really help anyone get a really good understanding of where they're at, work out some of the challenges they've been having, why they're not actually exceeding the goals, and also what they need to do to achieve their goals. And we're offering this free value. It's normally worth $299, but we see it as a great way to give back to our generation, and also find suitable, let's be honest, find suitable people who want to become and join our community. So in this session, we'll identify your goals, we'll review your current financial strategy, we'll assess your opportunities. You get to ask one-on-one questions with a qualified financial advice and coach, with either Beck or Chris, and answer any questions, which is really great. And we do this by video or face-to-face. Video is preferable because it's easy and you can just do it. And it's a great way to get started and just have a check. Even if you've done some really great things and you're quite progressed, we love working with really great people who are actually financially savvy, but we're willing to do it with anyone in our generation. So I'm just going to go back to my screen now so we can actually answer any questions that we have. So please just write through in your functionality any questions. I've got a number coming through now, but please ask any. So I've got a question about someone asking about whether we should purchase our own home property or an investment property. And I think that's quite a good topic. My philosophy, and it's also similar to Chris Gray, who we work with quite closely in the property market, is generally it's better to purchase an investment property rather than your own home. And there's a few reasons for that. One is due to the nature of our incomes, we pay a lot of tax. And when you actually purchase an investment property, you get tax deductions for any interest you're paying. So there's a reduction there. You also, the great thing about investment properties, you're generally emotionally detached, which is a really great thing. The danger of having your own home is you start seeing things that you want to improve. You want to get new light fittings, want to get new blinds, you want to get a new kitchen. And a lot of these times, they're not actually investment reasons. They're more because you actually want them. Where with investment property, you generally just go the basics and you only make decisions on if it's going to get you a return. So that's another reason why we like investment properties. And I think generally with investment properties, you buy them in places that potentially you don't want to live in, which means you make more commercial decisions. And also when you want to move, it doesn't really matter because you've got the investment property, you don't have to make that transaction. With people who buy their own homes, if they want to move or upgrade, they have the danger of having to sell their own property, which can cause high transaction costs. The benefit of having your own home, of course, is you've got that added security. There's no capital gains tax when you sell, which is quite valuable. And you can actually do self-improvement homes. We're friends with Danny and Dan from the block, and I'd be recommending they buy their own homes because they can really improve it. Myself, I can't even change a light bulb, so there's no help I can add to a property there. So just really think about the benefits there and don't feel pressure from parents. That's a big thing that we see. Parents trying to make us do what they did, and we're completely different. We're a different generation. I've got another question about shares, direct shares versus ETFs and managed funds. Really good question. It's part of our investment philosophy is we like to get exposure to some people to direct shares, but through a managed fund structure environment. So we don't want people picking their own shares. And a lot of people come to us saying, oh, shares are risky and everything. And then we go, why? And we look at their track record of how they actually purchased their shares. And they were speculating. They were pretty much gambling. They were seeing a tip from a mate and going buying a small mining stock, and then suddenly seeing their investment vanish 50% over in a couple of weeks. And the danger of this is you start not realizing the benefits of compound interest and doing regular investments. So what we like to do is get people to get exposure through direct shares through something what we call a separate managed account. So what that is a structure where you've got a professional manager managing it, so you don't have to actually pick and choose, but you actually see the underlying shares that you own, and you also get to benefit like you actually own the direct shares. And the reason why we do this is share investing is a huge part of building wealth, and it's important to learn the attributes of share investing at a young age. See them going up or down, understand that you get income as well through dividends, and the benefit of having this structure is you get to see this. So we like that option. We also use exchange traded funds for really cheap exposure to the markets. So when we just think we need direct exposure to the market, so for example, we've got a bunch of international ETFs that we use, and we want to get a broad exposure to, say, for example, China. We have no idea how to invest in Chinese investments. You actually can't, but this way you get a direct index. So if China investment market goes up, we get a direct exposure for a very cheap price. And sometimes we use managed funds as well. We use managed funds in the alternative assets space for hedge funds. And so you'll look at it and you can go, well, once again, we use all three, but it depends on the right type of goal, the right investment that you should actually use. So that's a really great example of what's important to you. In my own personal investments, I do exactly the same as what our WE members do. We have passive investments, we have ETFs, we have our SMA in our own personal names. And where I do some more speculative share investing is in my self-managed super fund, because I've built up a large self-managed super fund, and I do some investments there because I've got some longer term, and I enjoy that. But that's after 7 years of looking after a lot of professional money as well. Okay, I don't have any more questions, so I think I'll wrap up. But please feel free to send through any emails with questions to me afterwards. We'll be sending this out to people afterwards. And if is there any particular topics you'd like for future episodes, just please send them through, and we'll be doing this monthly. So have a great day. Good luck on the Oaks, and look forward to chatting to you soon.